Hi there, Trevor Ramos, investment advisor with Matrix Private Wealth Solutions. If you're investing for retirement or thinking about investing for retirement, you might have heard about index funds. These funds track the performance of a specific group of stocks or bonds, like the stocks followed in the S&P 500, the Nasdaq, the Russell 2000, the Dow Jones, or the bonds followed by the Bloomberg Barclays US Aggregate Bond Index. Index funds have become really popular lately because they're simple, diversified, they're not terribly speculative investments, and they can have lower fees. For example, an index fund will usually have lower fees than an actively managed fund. And that's because the investment strategy is passive rather than active, which means that the fund manager doesn't actively choose when to buy or sell investments. Instead, the fund invests in the stocks that make up the index, and while the investor does not own those stocks directly, the index fund's returns will largely mirror the performance of the index that you're tracking. Now, studies have shown that over a 10-year period, more than 70% of actively managed funds underperform their benchmark index. Some indices like the S&P 500 have done better than actively managed funds over the long term. For example, from 2005 to 2020, the S&P 500 outperformed 70% of large cap actively managed funds. And that means that if you invested in an S&P 500 index, you'd probably do better than most large cap actively managed funds. But index funds still have some costs, like an expense ratio, which is a fee that is taking out of the returns, just like most fees, really. Also, not all index funds include the dividend payments in their returns. So while index funds might track the price increase or decrease of the stocks, they don't always include the returns an investor might get from being invested in that stock directly and receiving the dividend payments as well, which is very important because there have been times in history where the majority of the returns of those stocks followed by an index are actually the dividends, not the price appreciation. So index funds offer diversification because they invest in all the companies within an index. But sometimes they're weighted more heavily towards a few stocks in that index that are more expensive or possibly overpriced or in a bubble. This can cause your portfolio to be overexposed to the risk of that stock or that industry that is more heavily weighted. It's also worth noting that while indexing can give you diversification, you're still exposed to the risk of the overall market. While index funds can provide diversification within the market, it can sometimes be too much diversification, meaning you don't have to be invested in all 500 stocks within the S&P 500 to have proper diversification. 20 to 30 carefully picked stocks can provide enough diversification and allow you to really concentrate in the stocks that align with your investment goals, like growth or safety or recession appropriateness. Index funds may not be the best option for conservative investors or those near retirement because they can definitely come with losses, especially in the short run. For instance, recently the S&P 500 has dropped, has periods of drop. Therefore, if you were in an index fund, your fund would be down as well. And that's not always a great position to be in if you're retired or near retirement. Also, because an index fund is largely a passive investment, it has much less flexibility than an actively managed fund, and the fund will not convert to cash if the market is expected to have a significant loss, which you can do in an actively managed fund. Ultimately, whether you invest in an index fund depends on your investment goals and your risk tolerance. While index funds offer a low cost, diversified investing, they may not be the best for everyone. If you have questions about investing, I'm happy to help. Again, my name is Trevor Ramos. Just reach out to me and I'll send you a link to schedule a chat. Trevor Ramos, investment advisor with Matrix Private Wealth. You have a great day.